Good afternoon, everyone, and welcome to our 2025 Farmland Leasing Market Update. I am Katie Nooner. I'm an ag business field specialist located in Lafayette County, Missouri, and I am joined today by some colleagues of mine. We have Drew Kinsey. He is in Northeast Missouri, just north of Troy. Jake Heffley is in South Missouri in Taney County, and Denise Ferguson is in St. Joe, Missouri in Buchanan County. So we have good representation for almost all four corners of the state of Missouri today. And we're looking forward to sharing with you um, some thoughts on where we've been and where we're, maybe headed with farmland leasing. So some of the objectives today that we're going to cover are where we're currently at with our 2025 returns to crops and cattle, kind of where we think we are headed in 2026 with some forecasts. And then we're going to talk about our current cash rental values, maybe some thoughts and theories on 2026, and wind up our hour with some trends and frequently asked questions. We wanted to cover some topics that we're getting asked more and more in our counties that we cover, and we thought we'd share those frequently asked questions with you as a group as well today. So thank you for joining us. I do want to share that this is being recorded and will be available to you with a follow-up email after the webinar today. And with that, I am going to turn it over to Drew. So Drew, why don't you kick us off and get us started?
Thanks, Katie. Like Katie introduced me, I'm Drew Kinsey. And I'm going to be starting off today talking a little bit about where the farm sector is at coming out of 2025 and where we're thinking things are going to head into 2026. So as far as the row crop side, throughout 2025, agricultural prices are not what they once were for sure. Coming out of the pandemic, we had a pretty good run in terms of crop prices in 2022, 2023, especially really continuing to 2024 to some degree. But different economic conditions have certainly tapered things back down. This graph here shows an index of all row crop prices of the commodities that are commonly grown across the state, with some that are specific to the Southeast region, but they are grown here. And the 100% line is relative to where prices were back in 2010, so before the run up for the 2012 drought. And as you can see, certainly the three major commodities, corn, soybeans, and wheat, grown across the majority of the state, are actually below the levels they were back in 2010. And cotton is probably added to that list, and that might be the hardest hit, one of the hardest hit of all, is cotton, because our input cost for cotton has just absolutely exploded. We all know what cost structure have done on things over the last 15 years. So certainly profitability for the row crop sector is not in the best place right now. And the projections you can see in the gray on the right-hand side of the screen aren't really indicating that things are going to get a whole lot better in the near future either. So when we compared a few different corn crops, we'll just talk about corn for an example here today. We're looking at 2019 crop, 23 crop, and the 2026 projected crop. 2023 kind of highlights the peak of the good times in this last cycle. Growing corn, we could expect about $1,000 an acre in revenue. We'd have pretty reasonable seed costs. Fertilizer was high, but it always is when commodity prices are up. Machinery costs are pretty high due to a lot of supply chain shortages from the pandemic still getting figured out. And what we ended up with was a total cost around $700 in return to land. So this is what the farmer has left over for their profitability and also to pay their cash rent or crop share, whatever else might be left, was about $321 an acre. So a pretty decent return, even if we take $180 or $200 out of that for our rent. Looking forward to 2026, we're thinking that our total revenue is going to be about $250 lower per acre than it was back in 2023. Our total costs, if we look at our percent change over in the farthest right column, is really pretty reasonable. A lot of things have come down with the exception of our weed and pest control, which there's a lot of factors behind there, but that's about doubled over the last 3 years. So that is affecting things a little bit. And we end up with a total cost for a corn crop that's up about 5% from the good time from the peak of the crop cycle back in 2023. And a return to land that's about $44 an acre. So what that means is for the farmers' profits and to pay their cash rent, they only have $44 left over to pay those things. And I don't know about you, but if I was written out a pretty decent farm and I got $45 an acre in cash rents, my farm broke even, I wouldn't be too happy. So when your tenants are, you're thinking about, man, it's really tough. You're right. It's pretty hard to pay cash rent and make a living on $44 an acre. So one thing that we see a lot is that many people are going back to 2019 and saying if we could only go back to 2019, but our revenue is lower. It's we're $200 an acre or more money we're bringing in compared to 2019, but things have just changed so much on the input cost side that our actual return to land is down about $120 an acre in the last 7 years. So even though a lot of folks we're getting more money written to us on those checks, but the profitability is just not there, and it's leading people to want to go back to those lower revenue times just to get a taste of those lower inputs again, where things were stable and there was a little bit of return that you could get in row crop farming. We move over to the cattle side, it's certainly a different story. So our cattle market, we've got a pretty good spread, as you can see, between our corn price, or excuse me, our feeder cattle prices on the red line and our corn prices on the gray line, to kind of get a comparison for what our cattle feeders are doing. So that's a pretty significant change, or that it's pretty significant opportunity for our cattle feeders in terms of what their actual costs are in their cattle. But even though there's that opportunity for our cattle producers, the market's been choppy and there's a lot of uncertainties there as well. Over the past 90 days, there's been a lot of downward pressure on the cattle market. We've been at record highs back in October, but there's been a lot of different policy moves which has driven that down. And actually, we've gone down a little bit farther since my graph cuts off about November 15th. We spread that out to the last year, on the other hand, we end up with a little bit different picture. If we compare our lows set middle of November and look backwards, that only takes us to about July when we surpass those previous highest record prices forever. So really, we've only been set back about 4 months in this cattle market, and we bring that out 5 years. That's even more noticeable at how relatively good cattle prices still are. So we break that out in terms of our budgets. This is from the MU Enterprise budgets for 2026 on our cow calf market. For cow calf, we're looking at a return to our pasture, investment in the cow herd, and operator labor of somewhere near $1,000. Now, our prices have changed quite a bit since October 17th when we put those budgets together. Now that's more like $500 or $600 a head, but still a pretty decent return for the cow calf enterprise. Our replacement heifers are still around that $410 mark projected, with pretty high sales, with people still wanting to invest in their herds. The heifers are selling really well, about $4,000 a head per bred heifer, and feed costs are reasonable. So so throughout the whole cattle spectrum, there's some profitability there. And the only weakness you might see there might be in the pasture backgrounding, but that's just because of the high buy price on those cattle. When we look at what's happened on November 24th and the change has occurred, things have certainly got upset a little bit by those market shifts that I was mentioning. Like I said, our total spectrum of change, we're gone from 1,000 to about 600. But what I want to call attention to is, even though I talked about return to pasture, investment, and labor, our total costs, which include what would cost to have our pasture, which is say $300 an acre, $300 a cow, excuse me. Our investment in the cow herd, which is our interest on those high-priced mama cows, which are $2,500 a piece times 8%, about another $275, and then our labor, which is another $200 or so a head. Our return to total costs are actually still aren't looking overly pretty, given where current market prices are. So just because that market's on a tear doesn't mean it's all roses for our cattle producers.
Thanks, Drew. I think that leads into my first slide. Again, everyone, my name's Denise Ferguson, and I'm going to run through a couple minutes and talk about current cash rental values. So cash rent's one of those very critical decisions anytime you're dealing with a farm lease agreement. It's going to impact your profitability for both the landowner or the tenant. Yet the problem is determining that right number isn't as simple as just picking a figure that feels fair. So without a solid benchmark, negotiations can quickly become uncertain or even strained. And that's why starting with supported survey data is essential. These benchmarks can provide a foundation grounded in real-world trends and regional averages, giving both parties confidence that that discussion begins from an informed position. So on this slide, so with that being said, there are going to be two sources that we're going to talk about real quick. The first one is the USDA NAS Cash Rental Rate Survey. It's an annual survey conducted by the National Agricultural Statistical Service. Those surveys are sent out in February, and around August, everything has been submitted that's going to be, and it's all tabulated and released as a report with cash rent estimates based on those responses. So what it reports is cash rental rates per acre for non-irrigated cropland, irrigated cropland, and pasture. The data that's published is at the state and county level, so that makes it very localized. And it's based on responses from farmers and landowners who rent land for ag purposes. So why is this important? Well, farmers use that survey again to negotiate their leases with confidence. Knowing what typical rates in their area are help them, feel like they are covering all their expenses and negotiating that fair deal. And then from the landowner's viewpoint, they're relying on those surveys to set competitive rental rates, reflecting those local market conditions that they might not be as familiar with as the tenants. So if we go to the next slide, talking about pasture land rental rates. So this, the line graph that you're looking at, it illustrates Missouri's pasture cash rental rates. It's covering the past 30 years, ranging from 1994 all the way up to 2025. And as you can see, that trend shows a steady upward trajectory reflecting long-term growth in rental rates. In 2025, the state average increased by about 3% over the previous year, moving it a whole dollar from $36.50 to $37.50 per acre, but it's still aligned very closely with that historical trend line. And then on the right, you'll see that county level map of Missouri shaded in varying shades of purple. The darker the shade represents a higher pasture rental rate being seen, ranging anywhere from $10 per acre to $72.50. So this just shows you the regional differences in land values across the state. My next slide will talk about non-irrigated cropland. So this line graph is showing that that state average from 24 to 25, it was unchanged. It stayed at $148 per acre for a state average. Again, staying perfectly on that trend line. Well, actually getting right back to that trend line. On the right, you see that county level map, again, in shades of this time blue with the darker shades representing higher rental rates. These are ranging anywhere from $17 per acre all the way up to $270 per acre. And just taking a step back and looking at that map, you might notice that the northern half of Missouri is commanding higher rates. And if we think about why, there's several factors that drive this. There's higher productivity, and those northern soils are well suited for those high yield crops like corn and soybeans. There's greater farm income to be realized from that because there are higher yields, meaning more revenue. Then the demand for land goes up and it pushes the rent up. It's more favorable topography, the land's flatter, and just that strong market performance over time has created strong commodity prices and historically low interest rates, and that boosted that land value and the rental rates in the north more than in the south. The last slide of this little group is the irrigated cropland. The line graph is showing that increased 1%, moving from 210 to 212 per acre. And that change closely follows that long-term upward trend line once again. On the right, you see that county level map. This time it's in orange, representing those higher rent lands or the darker shades. And that range went from 179 to 260 course, it's concentrated mainly in that southeastern lowland or boot hill region, which accounts for about 85% of Missouri's irrigated acres. And to a lesser extent, there's a little bit along the Missouri River. So why do these irrigated acres command higher rents than the non-irrigated? That answer lies predominantly in the productivity and the consistency with the irrigation systems and water access that just allows them to command a higher, more reliable, they get higher, more reliable yields, have more crop diversification, and that lets them command a higher rental rate. Let's see. So the other source, so remember that was the USDA survey. The next survey that I want to talk about is our actual MU extension cash rental rate survey. So in extension, I work all the time with landowners and farmers trying to help them make some sort of an informed decision about rental arrangements. If it's one of the number one calls we get in local offices is, hey, we're looking at discussing our rent. What's the rent for my county? So the Ag Business and Policy Program every 3 years conducts a statewide survey, and we look at it to supplement the USDA survey for our local Missourians to use when they're doing their negotiations. So that most recent survey was completed in June and July of 24. Over 600 landowners and tenants responded, mostly online. About 52% of the responses came from landowners. And after looking at those 600 landowners' responses, we had about 477 that were usable statewide. So while this survey provides a lot of valuable insight, it's important to remember that the number and the variability of these responses make it very hard to draw conclusions about statewide rental rates. Okay, so this slide, this very colorful slide that's coming up, shows you some regional classifications that we did with our MU extension survey. There are 6 regions. Missouri cash rental rates are influenced by several factors, of course, topography, crop and livestock mix, maybe location to urban development opportunities, access to rivers, and many more things. But in that 2024 survey, we didn't have enough responses to isolate each factor. So we used economic relationships and topographical maps to group these rates by regions. So on this map, you'll see 6 regions identified by color. For example, the northern region is shown in dark blue, and it's very small, but the average rental rates are $213 per acre for non-irrigated cropland and about $66 for pasture land. And then in comparison, nearby the river region, which is highlighted in orange, it runs along the Missouri River on the west, and then kind of like out the I-70 corridor and a little bit back up alongside the Mississippi River on the east. That averaged $209 per acre for cropland and non-irrigated cropland, and $43 for pasture land. Irrigated cropland rates are reported within that Southeast Asian region only, even though there's some irrigation that exists elsewhere. And on my next slide, this table, it's designed to help you connect expected crop yields and cash rental rates as a starting point for when you're negotiating. While statewide averages can mask local conditions, regional analysis shows that higher productivity generally supports higher rental rates. So the table in the top half is listing rental rate ranges that range from under $100 per acre, you'll see, or up to over 200 per acre alongside the corn and soybean yields that match that. And it does give an average and then a range in the yields as well. And then in the bottom half of the table, you'll see average cash rental rate per bushel by region. For example, in the northern region, the average is 96 cents per bushel of corn. And if you picked out in that northern region, say Buchanan County, you can multiply that by Buchanan County's trend adjusted yield that is over in the map with the blue counties of 182 bushels, and you can get an estimated cash rental rate of $175 per acre. So with all of this being covered very quickly, just remember this is a guide. It's not a rule. Other factors like parcel size, local demand, market prices, they all influence the fair rent. So use this information to support your reasoning when you're negotiating that rate that works best for both parties. Okay, so I covered that pretty quick to give you some resources. And I think next we have Katie, and she's going to give you some thoughts on what we can look at for cash rental rates in 2026.
Yeah, thanks, Denise. So we're just going to kind of share a couple of thoughts on, maybe where we're headed in 2026, kind of from, a tenant perspective and then also from a landowner perspective. So the first thing that we're going to talk about is farm income. So uh, Drew kind of alluded to this earlier in the presentation, but we are expecting, overall, as a nation, farm income to decline in 2026. We saw the peak in 2022 with declining years in 23, 24. We did have a slight bump in 2025 in net farm income that was somewhat unexpected. I remember this time last year, kind of saying 2025 was expecting to be, maybe a flatter down year. However, we had some government payments that did come and hit, you know, that net farm income, which gave us a little bit of a boost in 25. However, for 2026, as of this time, there's nothing slated for government payments, though there is some talk about potentially, um, you know, a payment from, a tariff offset or some sort of government assistance, potentially in 2026. However, at this time, um, nothing is in concrete. So therefore, we're going to kind of go off the assumption that 2026 is going to be a down year from 25, and then relatively flat looking off into the near term future. So when we look at this from just a Missouri farm income level, you can see, 2024 being there on the left-hand side, $3.4 billion in net farm income as a state. And then in 2025 on the far right-hand side, $5.39 billion. So that increase was due mostly to livestock receipts. As you know, cattle markets are extremely strong right now, and government payments. So those two big things really bolstered income and gave us that 58% increase in 2025. Now, as we look forward from 2025 into 2026, we're seeing, about a 16% decline in that Missouri net farm income. And that decline is going to be really attributed to, maybe a slight decrease in livestock receipts. We're still working with a really small cattle herd overall, and not expecting those government payments to be coming in 2026, and then all other charges that can contribute to a decline in income, interest rates, expenses, things of that nature. So looking forward to our Missouri crop receipts minus expenses and excluding those ad hoc government payments, what this line is showing us for crop producers is that, the peak in 2022, steadily decreasing with that little bump in 2025, but still looking from, 2024, 2025, and into 2026, our crop receipts, once we, get all of our expenses paid, are under $50 per planted acre. So we saw a 9% drop in the 15-year moving average in 2025 alone. And we also, even with an increase in yields. So we saw, a drop in that crop receipts, even with the yield increase there. And that just doesn't leave a lot on the table for those cash rent payments. So looking at the cattle side of things, it's a much better, stronger story. In 2025, we actually saw a 17% increase in the moving average, that 15-year moving average in 1 year alone. So we had a few less marketings in 25 over 24 just due to the cow herd size. However, still looking at cow receipts, less expenses, we are up over $100 per pasture acre. So really strong cow receipts there when you subtract out expenses. So the next slide kind of shows maybe why there is a little bit of a concern, a cash on hand concern for crop producers. So this one's kind of a bit complicated to digest, but what this is the debt to asset ratio. This data came from Finbin, but it's showing the debt to asset ratio of crop farmers from 2023 and 2024. So generally, when we look at debt to asset ratios, anything above 40% or 0.4 is kind of cautionary. So that means to maybe take a look at kind of what we're doing in those operations. Anything above 0.7 or 70% is a stressed farm. So they might be really having some debt issues there. So as we look across this graph, we see that 50% of our crop farmers are working at that above 40% debt to asset ratio, or that caution. And almost 20% of our farmers are stressed. So that is of concern, because that means that 20% of our farmers are really having trouble covering their debts. Another interesting point in this slide is to see what might happen with these trends, because as we look at 2023 and 2024, the farmers that are managing their debt well, that are below that 0.40, are actually improving their positions from 23 to 24. However, the farmers that are stressed have really increased their debt capacity from 23 to 24. So it'll be really interesting to see what happens in 2025 with this, and if we continue to see these, more leveraged farmers with higher debt to asset ratios, continuing to increase that ratio, or if they're able to start to, maybe hopefully get themselves in a little bit better position. So just an interesting slide with some really interesting data points there. But as we kind of look at it from, a cropland values and rental rates, comparing land values versus, rental rates on a dollar per acre basis, we do start to see kind of a parallel in these two dollar figures. And rent kind of mirrors and might pull away, but then adjust back to a land value trend here. And what that tells us is that we really can expect to see about a 3.5% return to land value relationship in cash rent. And that's what that bar graph there on the right-hand side of your slide is showing. You're going to see that trend over time, and it kind of hovers around that 3.5%. However, right now in 2025, we're in an interesting position where we're really at about a 3% relationship from cash rent to land values. So that tells us that one of two things are going to happen here. Either cropland values are going to adjust down slightly, or cash rents are going to have to tick up slightly. So I would be interested to hear opinions from the group as far as what they think is going to happen. But kind of one of the two things are going to need to happen to adjust that trend that we see over time. So just some kind of thoughts and fundamentals on rental rates. Some things that are still supporting a really strong cash rental rate market right now is, by and large, there's still a strong demand by farmers to rent ground. I don't know of a landlord that has trouble getting their ground rented, or where I'm located here in the state. We're seeing resilient cash rent auctions. And cash rental rates haven't really increased as much as land values. So like I just said, around 3% return to land value. And that's really kind of helping farmers still afford those cash rents as best they can. And the additional government support and crop insurance premium support has really helped with those rent payments as well. And lastly, just kind of those endowment factors of, there's a lot of sentiment of, I just don't want to lose this ground. I can't afford to not pay this rent and to not farm this ground. I think there's a lot of emotions tied up into that, and sometimes it might not make good financial sense on paper, but it's emotion leading the way there too. Maybe some non-supportive fundamentals for, or the argument to decrease rental rates here is, we do still have some volatility in commodity price outlooks, and price outlooks aren't extremely strong right now. We are seeing tight profit margins 3 years in a row. Farm loans are really getting some increased attention. We just wrapped up our ag lender seminars across the state of Missouri. That's where we invite agricultural lenders in, and we talk about outlooks and where we feel like kind of the farm economy is going in the next year. And I must say, overall, I attended the event in Chillicothe but it was cautionary. A lot of lenders were very hesitant to increase lines of credit or were kind of backing off on lines of credit that had been extended to producers. They're in the middle of rewriting those farm loans and lines of credit now, and cash poor was kind of a general consensus with our group for sure. And I think that's also reflected in increased interest rates and variable leases, and also kind of maybe the hesitancy to lease on things like feeder cattle with those markets being so high right now. Loans for feeder cattle producers, they're going to have to really think through those and look at the risk side of those types of things. And lastly, we are seeing a little bit of increased no sales at auctions where, landowners are just not getting the prices that they want to for their ground, and they are just, maybe not selling because the market is not willing to pay the price that they're looking for. And with that, I am going to turn it back over to Drew, and he's going to kind of share with you some trends in farm leases. These are some things that are kind of hot button topics right now across the state. So Drew, I'll let you kick it off.
All right, there we go. Thanks again, Katie. Like I said, I'm going to touch on a couple of things as far as that are really kind of emerging in our row crop leasing, and then I think Jay Kethley's going to follow me up with a little bit about beef cow or leasing in the cattle world, and how that market's going and what some trends there are. But kind of everything we've set up so far has got us into a position where there's really quite a bit of pressure on farmers and ranchers across the state due to high input costs and a lot of turmoil in the markets. And that's left a lot of folks looking for some ways that they can try to reduce some of their risk in terms of the total cash exposure they have in their production on an annual basis. And one way that they're trying to do that is by looking into variable leases. And there's a couple of different forms of variable leases, and those are crop share leases and flexible cash leases. If you've been around the block for a while, crop share leases are probably fairly familiar to you. What those are is that's the farmer is renting ground, but they're paying their rent with a portion of the crop. So actually, at harvest, there's a lot of different ways you can break it up. A 50-50 agreement is pretty common. A 67-33 or 75-25 are kind of the typical breakdowns, but a landowner is actually going to get a portion of the crop, and the relationship is going to change based on which of those ratios I mentioned. So in a 50-50 relationship, the landowner is going to be expected to share quite a bit of the production expenses in that crop. So I know on my farm, we have a couple of 50-50 crop shares. The way those usually work is that both me as the farmer and the landowner split all the input costs pretty much straight down the middle, with the exception of machinery costs. I pay 100% of my machinery costs, my fuel, my repairs, everything like that. Basically, my machinery is in exchange for use of the land, and we each take half the crop. In a 67-33, that's going to change a little bit to where, for example, you might split fertilizer and chemical costs, but the seed is paid 100% by the tenant, and different things to kind of make that balance out. And in a 75-25 crop share, typically with that arrangement, the tenant is going to pay 100% of the crop inputs, and then the landowner is going to take only a 25% share of the crops. There's a lot of different ways to kind of break up the crop share lease, which can create a little bit of a management headache in terms of both splitting the crop and getting everything across the scale to make sure it's all weighed out fairly. And also having all the input costs fairly apportioned and keeping good records on that by farm, by field, and by landowner. One good thing or bad thing, depending on your view of it, is with the crop share lease, landowners will be a material participant in farming because they're getting a portion of that crop. What that means is you're going to have to file a Schedule F, which is the tax form for farmers. And it'll also enable you to participate in government programs. Those can be disaster programs through the Farm Service Agency, FSA. Those can be FSA special loans for farmers, as well as crop insurance programs The landowner will be eligible for all of those different things. And depending on how you work it out with your tenant, they might take care of some of the paperwork for you, or you might have to do that yourself. It just depends on the specific relationship. And those are all things that can be negotiated. A newer type of lease that can provide a little bit of flexibility based on crop success for the farmer is a flexible cash lease. The critical difference between a flexible cash lease and a crop share lease is that flexible cash leases are paid in cash, not with the crop. The way that's accomplished is we're going to be split up or look at the gross revenue produced by the crop or our yield times our crop price and assign a certain percentage of that to the landowner in cash, but not, like I said, not with the crop itself. And since we're paying with cash and not the crop, the result of that is going to be that our landowner is not a material participant in farming, and you're going to have a 1099 just like you would in a traditional cash rental relationship. And kind of the accomplishment of both of these is that we're transferring some of the production risk to the landowner. And typically that's for some return of higher or some, excuse me, and that's in exchange for a little bit higher return in an average year if everything is laid out correctly. Our landowner is going to benefit from any windfall profits from when we get those really, really good years where we get a combination of good yields and good price or one or the other and have a little bit better profitability than normal. The flexibility of either of these is going to make our leases stay relevant over a longer term. So as the economic conditions change, the total rent paid is going to change with that. As a result, we can pretty much have a lease agreement that might be pretty much unchanged for, or it could go unchanged anyway, for 5, 10, 20 years if you're getting along well with the other party. But the increased management in either of these makes it absolutely critical that there's a good working relationship in place. To kind of break down a little bit of how the flexible cash lease works, we're going to go into the 3 different components of the flex cash lease. First off is our base rent. So the base rent is basically like your spring payment on cash rent if that's something you're engaged in. It's making sure the landowner gets a little bit of a return on their investment. That's going to be paid out typically before the crop ever goes in the ground. So in the spring, kind of in the ideal flexible cash lease scenario, we're going to want to pay roughly 2/3 of the typical cash rent for the area upfront to guarantee the landowner some return on their investment. So in this case, we're assuming that our scenario is for a farm that averages 170 bushel an acre corn, 55 bushel an acre soybeans, and it rents for about $170 an acre on the cash rent market. And that's what we're going to be looking at in our example in a few minutes. The second part of a flexible cash lease is a maximum rent. The maximum rent can go in place in order to ensure that the tenant gets significant profits when we have a absolute knock it out of the park year. And we're going to typically want to set that maximum rent an equidistant length away, from the typical cash rent. And we'll kind of see why that works that way in a minute, and how that's kind of fares things up for both parties. The final and most critical part of a flexible cash lease is the rent factor. And the rent factor is basically saying what percentage of the total crop revenue, again, it's yield times price, is going to be assigned to the landowner as the rental payment. And typically, that's going to be a higher percentage for soybeans than it will be for corn. And we looked at the corn input costs earlier. And as you can see, that's pretty significant input cost. It's going to cost us about $600 an acre for our inputs, just as easy math for a corn crop. For a soybean crop, that's going to be significantly lower, probably only $450 to $500 an acre. So a higher percentage of the total costs that go into a soybean crop are going to be those inputs, which is why we're going to assign a little bit more of that soybean crop as rent. So again, let's look at our first example here in an average year. So we're looking at APH, which is long-term average, yields 170 and 55, and a corn price of 465. So when we look at to multiply that by our 23% rent factor, we end up with around $182 an acre for our final calculated rent or yield times price times rent factor. And even though our typical cash rent for the area is 170, an average year, we want to compensate that landowner for their assumption of risk in the flexible arrangement. So we're giving them an extra $12 an acre roughly for assuming that risk and giving the farmer the flexibility they need. Since we're paying $110 base rent in the spring, we have a fall payment due. That's the difference between our final calculated rent and our base rent, or about $72 an acre. Now we're going to look at an excellent year scenario where we have well above average yields and above average prices. So when we take 195 bushel an acre corn times 23%, times $5.25 market price times 23%, we end up with a final rent, calculated rent of $235 an acre. Now that's going to be higher than our maximum rent of $230 an acre. So once we're going to replace that 235 with our max of 230, replace the calculated rent with the maximum, and we're going to end up with a fall payment of $120 an acre instead of the 125 that it would be otherwise if we went with a straight calculation. Lastly, we have our poor year example. This is where we have pretty tough yields, not so good prices. They had a pretty good crop elsewhere in the country. So 125 times 370 times 23% leaves $106.38 as our final calculated rent. And that's what would be due if this was a crop share-esque relationship with no minimum maximum. That's what rent would be paid. However, since we have that minimum in place, we paid $110 an acre in the spring. Since that's more than $106.38, there is no fall payment issued in that scenario because our calculated rent is below that base or that minimum. So to kind of graphically illustrate a flex cash lease principle, what we end up with is we're looking at our rent paid on our vertical axis and our crop revenue on our horizontal axis. Fixed cash rent, as crop revenue changes, there's going to be zero change in rent paid. If you're paying $170 an acre cash rent, that's just what it is, no change. Crop share rent, as our crop revenue goes up, rent paid goes up no matter what. There's no minimums, no maximums, could be zero, could be 500, just depends on kind of what the overall market conditions are for the crop being grown. Our flexible cash rent puts some curves in the graph. We have our lowest section here is our base payment. If we're below, that was our $110 an acre mark. If we're below 110 in our calculation, we're only getting that base payment down in this quadrant, down in the bottom left quadrant. Once we get above $110 an acre and up to that 230, we're in our variable lease range, where as crop revenue increases, our rent paid will increase, and that's going to change very similar to how our crop share would. But once we get our crop revenue up over a level where our rent due is going to be more than that $230 an acre, we're going to reach our maximum payment, and rent's not going to increase anymore past that second vertical line. And kind of what we get into, and you kind of look at some advantages and disadvantages, and it all equals out in terms of area on the graph. If we set things up correctly, when our base payment, that's really benefiting the landowner, since they would be getting nothing in a crop share or less in a crop share, but we're getting less than we would in a fixed cash rent. But similarly, we compare the lower end area to the top end, and it all equals out on the other side. So as long as we're having a little bit of extra compensation in that typical year to make up for the risk being assumed, it all works out in the long run. Another common thing coming on in a lot of crop leases and pasture leases for that matter is conservation provisions. And that's pretty much just adding a secondary value proposition to the land in addition to the farming rights. And there's a lot of different things that can add value, and we'll get more into those. But you can primarily, if you want to see quite a few more details, there's an extension publication available. If you want to go into your search browser later, type in MU extension G421. That should get you to the publication pretty easily. So a few examples of conservation provisions and kind of how they impact the value of a land lease. Each one of these practices, and I just listed a few as examples, have a unique, or each benefit the landowner and the tenant in one way or another. So for example, I'm going to talk about field borders, which is basically putting a ring around your field with some grasses or other species in order to prevent wildlife and tree damage. Excuse me. That's basically going to help our input efficiency as a tenant, and it's also going to give some wildlife benefits for our landowners. So we're benefiting each. Then if we look at minimum tillage, that's going to provide some value to the landowner through reduced erosion, adding value to that property in later years, and it's going to save some fuel and machinery expenses for our tenants. And kind of how these things are going to help impact the rent there's a big variance depending on the practice, depending on standard farming practices, as far as what those impacts are. It's going to vary, but when we're considering adding conservation provisions to the leases, it is absolutely critical to kind of consider, what your priorities are as a landowner, what priorities are as a farmer, what current operation practices are, to figure out how those different changes are going to impact rent due and what is fair for both parties. With that, I think it's time to go to Jake to talk a little bit about beef cows and leasing them.
Yeah, thanks, Drew. Like Katie mentioned earlier, my name is Jake Heffley. I'm a field specialist in ag business in Taney County in the southwest part of the state. And thinking about trends in leases for this year, beef cow leases is something we talked about early just because, from talking to my colleagues and conversations I've had recently, especially in the last couple of years, it's a topic that has come up more and more from producers, just either doing it or thinking about it. And you think about the reason for that is likely due to high cow prices. Anyone that wants to expand or anyone that's looking to getting into the cattle industry or in cattle production, with prices the way they are, that's such a big investment to add animals to a herd or to buy a herd. And also, thinking about the age of our producers, a lot of our producers are aging and maybe want to sort of phase out of the hands-on responsibility, but not just sell their herds. So I think that's a lot of the reason why we're seeing beef cow leases. So what beef cow leases are, and I'm gonna give kind of the 10,000 foot view here, just briefly go over it so we get out on time. But think about what beef cow leases are. In a beef cow lease, a cattle owner provides cattle to a lessee. We call it an operator in a beef cow lease, either for a fee, which is usually $1 per head fee, or a share of the calf crop income, or it could also be a share of the physical calf crop. Works really just like a crop share lease. I think it often gets confused with contract grazing. In the conversations I've had, contract grazing is where you're paying someone for grazing rights and probably managing your cattle for, a short period of time, but not a long period of time. And when you talk about beef cow leases, you're also thinking about calves and gaining income from that. So, Drew, if you go back actually one slide real quick. Think about why each party might want to get into a beef cow lease from the operator or the lessee side. Again, I mentioned that high capital investment. Also, if you have to borrow money to purchase cattle, you avoid that cost with leasing. We look at interest rates; they're not necessarily low right now, so you might want to avoid that interest cost. Somebody with excess land or forage who wants to just temporarily add animals on their property, this could be something that you might want to look into. It also could give you access to, different genetics. If there's, genetics you want to add to your herd, you could lease animals, retain those calves, and add them to your herd. So it could be something that you want to do for that. And it can also be a way to receive or transfer ownership gradually over time. I won't talk about that much today, but I'll share a guide we have on beef cow leases that goes more into that. From the owner side, sort of the opposite side, if you want to reduce stocking rates temporarily without selling the animals, a lease can do that. Again, like I said, reducing hands-on responsibility, really thinking about aging producers who maybe don't want to sell their animals, but want to retain ownership, but have less, hands-on responsibility, can fit there. You can go ahead, Drew. So just some different structures for cow leases. Kind of mentioned this already, but cash lease is an option here, which is just a flat rate. Like I said, usually $1 per head. And typically, the operator who's leasing the cattle in this scenario would own the calves just outright. So this is the most simple lease structure, but it does put the majority of the risk on the operator. You think about no matter what kind of calf crop you have, what your weaning percent is, or no matter what prices do, cattle prices or input prices, you're paying the same flat rate no matter what. So that risk is going to be shifted more to the operator. The flip side of that, the risk reward kind of balance. If they have a great year, they're still just playing that flat rate. Share lease can be a way to split the risk reward a little bit between the owner and the operator more. Like I said, this can be a split of the calves or the income from the calf crop. That percentage is typically going to be calculated based on what percent of inputs, the input costs were contributed by the owner and the operator. Um, it's more complex to do a share lease and a cash lease. Obviously, there's a lot more record keeping requirements. You have to keep accurate records to make sure you have a fair share split at the end of the year, and you also have to calculate that share percentage. But again, it does allow the owner operator to share risk, and also, if the owner wants to be more involved in management, a share lease often works there where they can contribute more to the management side and the input side and be more involved in the management. So I won't go too much into flex leases because Drew really explained these well, but I don't really see this being used that much or really at all in cow leases from my personal experience, but I think it could have a fit. It could have a place in cow leases. Works similarly like Drew explained for crop leases, where you have that base payment, which is a fixed amount, and you'd pay up front at the beginning of the lease, which would either be a set dollar amount or you might figure a cash rent rate and then do a percent of that. Then you'll have a variable payment after the calves are sold, after the calf crop is sold, and that can be based on a number of things, really anything that both parties agree on. It could be winning percentage, it could be calf prices, it could be revenue, profitability, anything like that. And it can include a cap, again, like Drew mentioned for the crop share leases or flex leases, I mean. So I think that's all on the cow leases. Like I said, I just wanted to give sort of a broad overview because I know I've got more questions and talking to my colleagues, they're hearing more about it as well. There are some resources if you want to learn more about this.